In my previous video, is whole life insurance better than a high yield savings account? You might recall that I loaded in an insurance policy and I used that as a comparison to the savings account. If you want to see what those actual values look like, you'll want to check this out. Hi, thanks for stopping by. If you recall in my previous video, is whole life better than a high yield savings account? Using the Truth Concepts funding calculator, I compared an early cash value whole life insurance policy to a high yield savings account. That comparison showed that after 30 years, it was projected that the life insurance policy would have $661,000 more in cash value than the comparable savings account. And since it's life insurance, it would have 2.09 million more in death benefit. And that's why I think that comparison is so powerful. When folks say putting your dollars in whole life insurance is a bad idea, the first thing you need to ask them is compared to what? Compared to the stock market? Then maybe it is. Compared to real estate? Maybe it is. But that's not a fair, those are not equivalent assets. So that's the very first question. Compared to what? And if you watch the previous video, I think it shows pretty clearly that compared to a high yield savings account, putting your extra dollars into an early cash value whole life policy can be a very, very good idea. So, but to be fair to a savings account, if you are putting in $25,000 into a savings account or you're putting $25,000 into an early cash value whole life insurance policy, if you need access to that $25,000 and you know you're going to need it within a month or 2 months or 3 months or 4 months or something, it probably makes more sense to put that into a savings account. But if you don't need all of the cash because you are buying life insurance that has a cost, and even though we are designing it to be an early cash value style policy, it's not a 100%, one to one. So you'll that first year you have about 70% available in cash value that you can then leverage if you need it. And the next year you'll have 80%. And the next year it increases till very quickly you will actually have more available cash value than premiums that you've paid in. So if you don't need the dollars right away and you get all the benefits of life insurance, you get the death benefit plus all the other benefits, and you get we can, if you watch the previous video, you're getting as good or better or much better internal rate of return than you can get with a current day high yield savings account. Why wouldn't you do it? And that's what I'm creating these videos for, is just try to educate folks. I just don't think people are aware of it. Like these products have been around for almost 200, over 200 years, and people just don't understand them. It's just, there's so much misinformation out there. It's such a powerful, simple financial tool that nobody understands. And so that's the point of these videos. And hopefully I can help to educate you and help you out if you're interested in instituting one of these or multiples of these in your life. And that's the whole point of these videos that I'm trying to create for you guys. In that previous video, I was using a truth concepts calculator to model comparing the early cash value whole life insurance to a savings account. And what I did is I took a real life illustration and I loaded it into the calculator, and that represented the cash values and of the life insurance policy. And then I compared that to the savings account. And so what I thought might be interesting in this video is for those of you who might want to see what that actually looks like in real life. Like what does that policy look like in real life? And then I'm going to go through the illustration to kind of highlight some of the key areas of a policy. Some of you may not have ever seen one before, and especially you might not have ever seen an early cash value style policy. So I think it could be informative to just show you what I loaded into the calculator as a tool to compare the two options. So hopefully you like it, and let's get started. So what you see in front of you now here is the actual illustration that I used, that I loaded into the Truth Concepts funding calculator that was in the previous video. So I just thought you might find it interesting to actually see what one looks like. And this is an example of an early cash value, a whole life policy, or an infinite banking style whole life policy. And the key difference between one of those types of policies and a standard policy is that you build up immediate cash value that you can, you can borrow against, where typical whole life policies take a long time to build up that cash value. So what I'm showing here now is the two components, the base contract and the flexible protection rider, which is kind of it's unique to this particular carrier. But that 8,040, that's the base premium component of this policy. That would be considered like a standard whole life component. Then the flexible protection rider is a combination of term insurance plus paid up additions. It's a ratio, it's a blend. And each year, the very first year, it's more term insurance and less paid up additions. And the next year, it's a little less term and more paid up additions. So eventually, it becomes all paid up additions. And what that does is it creates a nice death benefit protection, and it gives you that death benefit headroom that allows you to purchase paid up additions so that you stay underneath the IRS MEC limit, the modified endowment contract limit. And so this is that 80/40 1960. That's that $10,000 kind of base portion of the annual premium. And then the next portion here is the EPPUA, which is the paid up additions rider component. And what this is this $15,000 is buying $15,000 worth of immediately paid up whole life insurance. So whenever you buy whole life insurance and it's fully paid up, it has immediately a recognizable cash value. And that's how you get that cash value that you can start to borrow against right away. That's the important piece. You have the base part, the term component, and the paid up additions rider component. That's those three components are what create what, an infinite banking style policy or an early cash value style policy. And the beauty of that is you get a lot of cash value that you can borrow against immediately, and you get a good death benefit protection immediately. So it's kind of a best of both worlds. That's what I really think it's such a powerful way to do it. And then that's the total premium that you pay on your annual date. The thing to note too is that the only piece that you're required to pay on your premium day is the base and the FPR in this case. That 15,000, you can spread that out over the next year, sometimes even over multiple years. You want to check with your agent. But the only part you need to pay on the due date is that base premium portion. And then you have flexibility with the other components. So insurance contracts are way more flexible than people realize. And so just something to keep in mind. And then when you pay that $25,000, that base plus FPR plus PUA premium, that's the immediate cash value. That very first year, within a week or two after you pay your premium, that's the amount of cash value that you can borrow against. And that's the difference between an early cash value policy and a standard whole life policy. And then that's the immediate death benefit that you get. The moment you pay your premium, that is protecting your family right then with that. That's a really great death benefit and protection because you have death benefit plus that cash value that you can leverage. And then this is the non-guaranteed portion of the ledger. It shows you the projected dividend. That's the profit of the company that the insurance company is projecting, and with as it applies to your particular policy and the dividend that they're projecting to pay back to you. And then what we like to do is we design these policies so that the dividend gets rolled into paying up more death benefit by using paid up additions. And so then that reflects immediate cash value so that projecting to increase your total cash value at the end of the year to 15,800. Yeah, so that's just saying, year two, that's just showing that already in year two, you're building up significant cash value. You could take a loan out against your policy to purchase a car. You become your own bank. You start to accumulate so much cash value. You can start to go to yourself for things of life instead of having to go to the bank. And then in year four, at this point, this is an important year. At year four, the projected increase in cash value now exceeds the amount of premium you're paying in. So that's kind of an important year to recognize. So you are now getting more each year than what you're paying in. That's the projection. And then year seven is the projected, this is like the break-even point. The amount of cash value that you can borrow against now exceeds the amount of total premiums that you've paid in. And so this is an important point because it just shows you now every dollar you're putting in, you're getting more than what you paid in, and it starts to really accelerate from here. And just shows again how that's increasing. And then this is just kind of a summarize that 35 to 15 for 25 years. that you have at that point 1.22 million in tax-free cash value that you can borrow against. You have 2.6 million in tax-free death benefit that can go to your family. So that just this page kind of highlights the kind of the summary of that. And then what I like to do with these two columns is it's really important to recognize that from the moment you have your policy in force and you pay your first premium with an early cash value style policy like this, you have significant cash value that you can leverage. It's a living benefit. So you have all these benefits that come with whole life insurance. And if with an early cash value style, you get the early cash that you can access, borrow against it immediately. And you'll notice that you can use it throughout that whole 25 years, you could be accessing that cash value. It's not put your money, pay premium, or go to the stock market, pay premium, or utilize go into real estate, pay premium, or fund your emergency fund. It's an and asset. Pay your premium and borrow against it to go to the stock market. Pay your premium and borrow against it to take advantage of a real estate opportunity. It's an and asset. It's such an important concept to understand that when you put your dollars into premium and an early cash value premium policy like this, you have cash value that you can leverage immediately for whatever you might need. Emergencies, opportunities, large purchases. It's just an important concept to get around. It's not sunk cost. You can utilize that cash value right away. It's such an important aspect of this. So I just want to highlight that here. And then this last page is just to kind of summarize it, that if you pay premium consistently, you can build up significant cash value over the life of your life that you can then bless your family with. And I just think this is such an important slide to show folks that there's no magic to it. It's just consistency, partnering up with an insurance company that's been around for 200 years, that has long-term, they've been doing long-term planning and executing for 200 years. They know how to pool risk. That is a company to partner with. The reserves that they have to maintain are so much greater than banks. The regulations and the requirements that they have to maintain within the states, so much more stringent than banks. I feel way more comfortable partnering with an insurance company than I do with a bank, to be honest, because they've been around for so long and they've been doing it consistently. And the best insurance companies, they've never not paid a dividend. Imagine all the history of the United States, every single year paying dividends. Just think about that consistency, that predictability. If you just pay your premiums, you can, with a high degree of certainty, pass on generational wealth to your children and to your grandchildren. And you don't have to take the risks that you'd have to take in the stock market or in real estate or in some other things. This can be the base, the foundation, financial family setup. So I'm going to zoom back out and we'll just wrap it up. So now is like the so what portion of the video. So hopefully what I showed you here is that first off, just kind of give you a behind the scenes look of what an insurance policy illustration looks like if you haven't seen one yet. Um, and then also like tie that into the previous video. Like that is the actual real illustration that I used in that video. And in that video, I showed you how powerful and early cash value whole life insurance policy can be in terms of the internal rate of return, the growth that it can have. And when you compare it to a like asset, like a savings account, it is as good or better in terms of growth, and you get all the benefits of life insurance. And so that's what I was trying to illustrate, and I thought you might find it interesting to go through an early cash value illustration. Might be helpful for you to kind of visualize it and see it. But then the last piece, the so what, is hopefully at that last slide I showed you. If you could just consistently pay premium and partner with a really good insurance company, set up an early cash value whole life insurance policy, you can get the best of both worlds. You get the great growth, you get the great protection, and you get the cash value that you can borrow against for opportunities, emergencies, large purchases. You can create your own financial system that you can leverage and to have total control over. And that's just the big pictures, and that you can then bless your family by just being consistent. You don't have to take the risk. You don't have to take the risk. That's what's one of the most important parts about it. You can consistently pay premium, and you will have the benefits that you can pass on to your family, and you can utilize it during the whole time. And so those are the big what ifs, or not what ifs, but so whats. And so hopefully you found this was interesting and useful and educational. And I also have a follow-up video. One of the other things that I think is really great about, and there's so many things, and that's the whole point of these videos, is to highlight how this asset that you just don't realize the benefits of, how it can be so helpful to your family. But the next video I'm going to show is how you can take the same exact policy and you can create tax-free passive income for yourself and in your retirement years, or passive income years, as Nelson Nash likes to call it. And so stay tuned for that, and I'll see you soon.